Well, hi, I want to talk about trading natural gas specifically, but this applies in general to whatever you're trading. And so this is just a chat, really. There are no charts. I'm not going to show you anything. I'm just going to have a chat with you to try and get this message across. I did put out a tweet and a short video trying to talk about this, but I think we could just spend a few minutes talking about it right now in this video. So just a discussion, really. A lot of people saw natural gas dropping from $10 to $7, where it hesitated and faffed around for a bit, where we were short at $10, short at $7, and then people started buying at about $3.50, including myself. And the price then moved down below $3.50, down to $2.60, and then $2.20, and then $2, and just below. In that process of a roughly 80% drop in the price of natural gas, a lot of people lost a lot of money. And I really want to talk about why people lost money and how you can avoid it, and what the strategy is that you should use in your trading if you want to be serious about trading and if you see a future for trading for yourself. If you're just having a flutter on a small account and you can afford to lose 30 or 40 or 50% of that account, that's fine. But if you're going to be taking your trading seriously and you want to do it in the future as a hobby, or perhaps even as a profession or a career like I do, then you need to be very aware of the problems that you're going to face if you take large bets on a single instrument, a single trade, and hope for the best. 95% of the time, according to the stats, I'm not sure how true they are, you will blow your trading account and lose all your money. That seems to be what the brokers say most people do. And you might win one or two trades. You might, double your account once, maybe twice, maybe three times. But at some stage, you're going to blow your account. You're probably going to try again, probably going to open a new account, refund it, whatever. And you might make a few gains again on another occasion. And then you'll probably blow your account again. And that's what happens to most traders. But if you're serious about trading and you want to have a long-term prospect in it, then you need to be more careful about your trades. And if you're trading one instrument, like many people do, my son, for example, trades two instruments, and I'll tell you about his story shortly. But if you're trading just a few instruments, you can't afford to risk all of your trading account on one trade or one instrument or one idea, one direction. You have to be very careful about the downside risks. And when you enter a trade, you have to be aware of where the market might move to and what would happen if that happens if you're wrong. And if you're wrong, you don't want to blow your whole trading account. And even if it's just a small amount of money, even if it's just a little bit, you still don't really want to blow it. I mean, no one likes losing money. If it's just a gamble, I suppose some people do that. I don't know. I guess that's part of human nature. So you've got to say to yourself, what if natural gas drops below $3.50? What if it does go to $2.50 or $2.20 or $1.97 as it did? Currently, it might go even lower. I don't know. What if that does happen? What is your out? What is your strategy? How much are you willing to lose? How much are you likely to lose, given your position size and the distance the price could potentially move? And how are you going to deal with all of that? As I said, I was long at, I'm just glancing at my charts. I'm busy trading while I'm recording this, so I'm doing two things at the same time. Now I've lost my train of thought as well. I was long at around about $3.30, I think it was, and the price dropped down to hit my stop loss, I think $2.90. I was out of there. In fact, my futures contract expired and I just didn't let it roll over. I closed it before the rollover. In the process of doing that, the process of losing that trade, I lost 0.7% of my account. Now, for you, that might not sound a lot. For me, that was a big loss, an unpleasant loss. And closing that trade, I closed it manually, was unpleasant. It didn't feel good. It was quite a lot of money because I have quite a lot of money under management and quite a lot of money for my clients as well, I think. For some of them, not so much, but it depends on how you view risk. But for me, 0.7% is a lot. If I'd held onto that trade from $3.50, with the price now having dropped down to $2 or thereabouts, I could have been 7 or 10% down on the trade. But I had a plan, and I managed to close that trade for a small in general, but for me, large loss. And then I was able to rebuy lower down, near closer to $2, and then let that trade ride. And then at $3, I hedged it and went short. So I have two positions open, one at $2 roughly, one at $3. And they're both in profit currently, one short and one long, equally balanced. Right now, it doesn't matter which way the market moves. And at some stage, and I think it's going to I think it's going to go to the long side eventually, back up to $3.50. But at some stage, I'll start to add on long positions and rebalance my hedge in the favor of the long side when I see the right market conditions to do so, which I haven't yet. So I've managed my position through the losing trade, and by entering a new trade and managing the risk on that position as well, I've actually managed to cover the loss of the previous trade and some, and also put myself in a healthy position simply by managing my trade and being sensible. So that's what I want to encourage you to look at. When you enter a trade, make sure that you know what you'll do if it goes against you. Every single market can be irrational, and often the markets are irrational. They don't behave according to what we hope they will most of the time. They do things a bit differently. Markets move in ways that we don't expect. And if the market does move against you, you have to be prepared to know when you're wrong and what you're going to do about it when that happens, and how to manage that risk position, how to manage the risk on that position, and to avoid a catastrophic loss. I want to say here as well is when the market does move against you, and I used the word wrong earlier, it doesn't mean that wrong in the sense of you made a mistake or you messed up or you made an error. That's not what I mean by wrong. It just means that you took a trade based on the right setups in your strategy. And make sure you have a strategy. Make sure you know how to read a chart for a start. Don't just sort of throw a peg at the dartboard and hope for the best. Well, the price has dropped a bit. Looks like it's too low. I'm going to buy. That's not the right way to trade. Have a strategy. But sometimes your strategy will go wrong. I win about 75% of my trades. I've taken thousands, tens of thousands of trades, and maybe hundreds of thousands of trades over the years. And 75% of the time, I'm correct. My trades turn out to be winners. But 25% of the time, my trades go against me. And I expect that to happen. That's not going to improve. I think 75 is really good. But I expect 25% of the time I'm going to be wrong. And that's just a fact of life in trading. It's the school fees that you pay. It's the tax that you pay. The costs of trading are the losses that you take, apart from the broker's fees and all that sort of thing. So if you know you're going to be wrong a quarter of the time, and that's a really good hit rate, by the way, I think if you can get more than 60%, you're doing pretty well. But if you're going to be wrong a quarter of the time, you know that 25% of the time you have to make plans, contingencies for those losses, and make sure that they don't result in catastrophic damage to your trading account. Now, it's all very well when your trading account's very small and you don't mind losing half of your trading account, if it's a few $100s or a few $1,000s. But what you'll find is that if you trade like that in the beginning, willing to risk a lot to gain a lot, you'll get into bad habits, and you'll carry those habits through into the future, and eventually that's going to harm you when you have a larger trading account, or perhaps you're doing it more seriously or as a profession. Those bad habits will carry through. So if you've got a small trading account, let's say it's $1,000, and a winning trade of 1% is $10. That might not sound like a lot to you, and it isn't a lot of money, but those little $10 bits will add up, and it'll teach you good habits, teach you good trading practice, and learn how to trade with those small accounts just as seriously as if it was a large account. I told you I'd tell you a story about my son who lives in London, who's learning to trade. He's in his early 30s, so he's not that young, and he trades, but he's learning the ropes. Now, he's in a similar position. I'm just glancing at my charts because I have trades on. And every time I glance away, it's not because I'm disinterested in talking to you. It's just because I've got my big screen over here. So he's in the same position I am in on a US oil short. So we're both short, same trade, more or less the same entry price, prices moved against us by a few cents, maybe 30 or 40 or 50 cents. The result of that on my trading account is about a 0.05% negative equity floating loss on my account. For him, because of the way I've sized my oil position in relation to my account and the other trades that I'm in. For him, he only trades oil in S&P. Sorry, Josh, if you're listening, this is not a slight on you or anything like that. It's just a good example. No one knows you, I don't think. For him, it's a 12% drawdown already by the price just moving 50 cents. For me, it's less than 0.1%. So that's the difference. He's oversized. He doesn't know where the limit is to get out of the trade if he's wrong. And he doesn't really know where the target is if he's right. So all of the basics are in place in terms of perhaps the right direction, hopefully the right direction, and the right instrument and the right trade. But his management of that trade in terms of sizing and risk management is completely wrong, which may result in a large drawdown, maybe a floating loss, and then potentially a good large profit for him. But there's risk to his trading account far beyond what it should be. I trade across a variety of instruments, and I believe that diversification in your trading is one of the keys to risk management. So I trade stocks, stock indices, stock names, individual names. I trade metals, I trade currencies, I trade various commodities, and I'm in a little bit of each of them all at the same time. So I might be long oil, short gas, long gold, short the euro, long the British pound, whatever it might be, short S&P, long NASDAQ. I'm diversified across a range of instruments, currencies, commodities, etc. And in that way, it helps me to minimize my risk. And I also try to make sure that I'm not in any particular direction against the US dollar, which kind of governs everything in the markets. So we don't want to be betting everything one way or the other against the US or for the US dollar. I totally get trading just one or two things and focusing on those. There's no problem in that. But just bear in mind that you have to manage your risk slightly differently if you're focused on one or two instruments. So that's the difference between my son and myself. Same trade, same entry price, but the risk profile and the trade management is completely different. Anyway, I just wanted to share all of that with you. If you're trading natural gas in particular, be aware it's incredibly volatile. It's called the widow maker. I know not for the reasons that we actually use it in terms of making traders and their families, creating widows in traders' families, but it is a very volatile instrument. And remember also, when you're trading commodities, they're not rational. They're tossed about. The price is tossed about by supply and demand, international events, pipelines, shipping, weather, you name it. Anything that you can think of goes into the commodity price, and manipulation on top of all of that. So when you're trading gas and other commodities, just be aware that the price is not going to do what you expect it to do a lot of the time, and there will be enormous variations and fluctuations, weird, crazy moves that will and can, I should say the other way around, can and will go against your ideas and your price and your position. Very, very often you have to be able to manage that. So I hope you found that useful, and just a chat really. So again, no charts, nothing apart from the ones I'm looking at and glancing at every now and then. And if you found this content useful, please just like the video, and if you feel like it, just subscribe to the channel as well. It really helps the channel, and good luck with your trading. And if you've got any comments or anything you want to discuss, put it in the comments below, or you can contact me at ArcisFX.com. My contact details are on there. Take care.